The European Union spent 5 years and hundreds of millions of euros building a digital currency that would give Brussels total visibility over every transaction its 450 million citizens make. They called it the digital euro. They said it was about convenience. They said it was about modernization. What they did not say, and what Elon Musk figured out, is that it was also about control. And now, in the same month that the European Central Bank is pushing hardest for adoption, Musk has launched X money in Europe. Not next quarter, not next year, this month. The man who bought the world's biggest public square is now building the world's most disruptive digital wallet right inside the EU's backyard. Brussels is furious. The ECB is rattled, and the race to control how 450 million Europeans spend their money has officially begun. To understand why Musk launching X money in Europe right now is one of the most explosive financial power moves of this decade, you need to understand what the digital euro actually is and why so many economists, privacy advocates, and ordinary Europeans have been quietly terrified of it for years. The European Central Bank officially announced the digital euro project in 2021, framing it as a natural evolution of the Eurozone's financial infrastructure. The pitch was simple. A digital version of the euro issued directly by the ECB, usable by any citizen in any of the 20 Eurozone member states, accessible through a smartphone app, and designed to work even without an internet connection. On paper, it sounded like a government-backed upgrade to your existing bank account. Convenient, safe, European. But the details buried inside the ECB's own technical documentation told a very different story. The digital euro, as currently designed, is a central bank digital currency, or CBDC. Unlike the euro sitting in your commercial bank account right now, a CBDC is not held by a private bank. It is issued and tracked directly by the central bank. Every single transaction, every coffee, every grocery run, every wire transfer is recorded on a ledger that the ECB, and by extension EU regulatory authorities, can access in real time. The ECB called this feature supervised privacy. Privacy advocates called it something else entirely. They called it a surveillance payment system dressed in government branding. And here's where it gets even more alarming. The digital euro design includes a programmability feature. That means the currency itself can be coded with rules, expiry dates on stimulus payments, so you are forced to spend money within a set window or lose it. Spending restrictions that prevent digital euro funds from being used on certain categories of goods. Geographic limits that block cross-border transactions without prior authorization. None of this has been officially activated yet, but the technical architecture is already built to support it. The infrastructure for financial control at a granular individual level exists inside the digital euro framework. It is not hypothetical, it is engineered. By early 2025, the EU Parliament had passed the digital euro framework into formal consideration, and the ECB was running pilot programs across 7 member states, including Germany, France, Spain, and the Netherlands. The timeline was aggressive. A full public rollout was being targeted for late 2025 or early 2026. ECB President Christine Lagarde publicly stated that the digital euro was essential for European monetary sovereignty, a phrase that sounds like financial independence, but to critics translated directly as, "We do not want American payment platforms deciding how Europeans spend their money." That one phrase, monetary sovereignty, is the key to everything that happens next. Because Lagarde was not talking in the abstract. She was talking about Visa. She was talking about MasterCard. She was talking about PayPal. And most of all, she was talking about the growing dominance of American big tech in the European payment space. The EU had watched for years as its citizens handed over their financial data to Silicon Valley platforms. Every tap of Apple Pay, every PayPal checkout, every Venmo-linked transaction, all of it feeding data back into American corporate ecosystems that Brussels had zero jurisdiction over. The digital euro was, at its core, Brussels' answer to that problem. A European financial system controlled by European institutions, no American intermediaries, no Silicon Valley data harvesting, pure regulatory sovereignty. And then came Elon Musk, the single most confrontational American tech billionaire on the planet. The man currently in an open political war with the European Commission over X platform's content moderation practices. The man who called EU regulators unelected bureaucrats on his own platform in front of 200 million followers. That man announced that X Money would be launching in Europe, not as a distant future product, not as a beta test, but as a live, functional payment service this month. The timing is not a coincidence. Musk's team had been quietly building the regulatory groundwork for X Money's European entry since mid-2024, when X secured an e-money institution license from the Central Bank of Ireland, the same regulatory gateway that dozens of American fintech companies have used to access the entire EU single market. That Irish license is the legal skeleton key to the European financial system. One approval, 27 markets, and Musk used it with surgical precision. X Money, in its current form, is a peer-to-peer payment wallet embedded directly into the X platform. Users can send money to other users, store balances in a digital wallet, and link external bank accounts for transfers. In the United States, X Money has already been processing transactions since early 2025, but Europe is a different battlefield entirely. Europe is where the digital euro is being born. Europe is where the ECB has the most to lose, and Europe is exactly where Musk chose to plant his flag. The question that every financial regulator in Brussels, Frankfurt, and Paris is now asking behind closed doors is not whether X Money will be popular. They already know it will be. X has over 67 million active users in Europe. The platform is free. The interface is already familiar. The payment feature requires zero additional downloads, zero new accounts, zero friction. It is built into an app that tens of millions of Europeans already open every single morning. The real question, the one keeping ECB officials awake at night, is whether Musk just made the digital euro irrelevant before it even launched. But what those regulators do not yet know is that X Money is not just a payment wallet. It is the first visible piece of something far larger that Musk has been building in secret for over 18 months. And when the full picture becomes clear, it will not just threaten the digital euro, it will threaten the entire architecture of how Europe controls money. To understand the full scale of what Musk is actually building, you have to go back to 2023, when he first publicly stated that X would eventually become the financial layer of the internet. Most people laughed. Analysts dismissed it as another Musk overpromise. Tech journalists filed it under the same category as Mars colonies and full self-driving by next year. What almost nobody did was take him literally. That was a mistake. Because while Brussels was drafting digital euro legislation, while the ECB was running pilot programs, while Christine Lagarde was giving speeches about monetary sovereignty, Musk was quietly assembling the most dangerous fintech infrastructure in the world, piece by piece in plain sight. The foundation was laid the moment Musk acquired Twitter in October 2022. Within weeks of the acquisition, before he had even finished firing half the staff, Musk's team began filing for money transmission licenses across the United States. By mid-2023, X had secured licenses in over 30 American states. By late 2023, the company had hired a dedicated payments team poached directly from PayPal, Stripe, and Square, three of the most powerful payment processors on Earth. The message was unmistakable to anyone paying attention. This was not a social media company adding a tip jar. This was a social media company transforming itself into a bank. Then came the Ireland move. In September 2024, the Central Bank of Ireland quietly approved X's application for an e-money institution license. The announcement was made in a regulatory filing that generated almost no mainstream media coverage. But inside fintech circles, it was treated as a seismic event. The Irish e-money license is the single most valuable regulatory passport in the European financial system. It grants the holder the legal right to issue electronic money, hold customer funds, and process payments across all 27 EU member states under the EU's Electronic Money Directive. No additional country-by-country approvals required. One license, full continental access. Musk had just walked through the front door of European finance with a master key that Brussels handed him voluntarily. The EU's own regulatory framework made it possible. The same single market rules designed to encourage competition and innovation in European finance. Rules that the EU had written specifically to prevent American tech monopolies from dominating European markets. Those exact rules handed Elon Musk a legal pathway to operate a payment service for 450 million Europeans without asking a single national government for permission. The irony is almost too perfect. Brussels built an open door to protect European financial sovereignty. Musk walked straight through it. By January 2025, X Money had gone live in the United States with a feature set that was deliberately modest: peer-to-peer transfers, wallet storage, bank account linking, nothing that would trigger immediate regulatory alarm, nothing that looked on the surface like a threat to national monetary systems. Analysts described it as a Venmo clone with a larger user base. Safe, familiar, boring even. That was exactly what Musk wanted them to think. Because while the product that launched in America was simple, the product being built in parallel, the one designed specifically for the European rollout, was anything but. Internal documents leaked to 2 European financial publications in February 2025 described a version of X Money engineered for the European market that included features far beyond basic peer-to-peer transfers. The European version was being built with multi-currency wallet support, allowing users to hold euros, British pounds, Swiss francs, and Polish zloty simultaneously within a single interface. It included a merchant payment layer that would allow businesses to accept X Money directly, bypassing traditional card networks entirely. It included a cross-border transfer system designed to make international payments within Europe instantaneous and fee-free. And it included an interest-bearing wallet feature that would allow users to earn returns on stored balances, a feature that, under European financial law, edges dangerously close to the territory of a deposit account offered by a licensed bank. That last feature sent regulatory alarm bells ringing from Dublin to Berlin, because if X Money is holding customer funds and paying interest on those funds, it is no longer functioning as a payment service. It is functioning as a shadow bank. And a shadow bank operating at the scale of X's European user base, 67 million active users, potentially growing to 100 million within 18 months of launch, would represent one of the largest unregulated deposit-taking operations in European financial history. The ECB began internal discussions about whether X Money's European feature set would require a full banking license rather than just an e-money institution license. Those discussions are still ongoing. And while Brussels debates, Musk is already onboarding users. The competitive threat to the digital euro is not subtle. The ECB's own research showed that European consumers adopt new payment tools primarily on the basis of 3 factors: convenience, trust, and network effects. X Money scores devastatingly well on all 3. Convenience, because it requires no new app, no new account, no new learning curve. It is already embedded in a platform that European users check an average of 6 times per day. Trust, because despite Musk's political controversies, X's brand recognition in Europe is near universal, and financial trust tends to track platform familiarity. And network effects, because every new X Money user makes the service more valuable to every existing user. A compounding growth dynamic that the digital euro, launching from a standing start with no existing user base, simply cannot match. But the most dangerous weapon in Musk's European arsenal is not X Money itself. It is what X Money is designed to connect to. Because buried inside X's long-term product roadmap, confirmed by 3 separate sources with direct knowledge of internal planning, is a feature that would turn X from a payment platform into something that has never existed before in the private sector. Something that, if it launches in Europe before the digital euro achieves mass adoption, would not just compete with the ECB's digital currency, it would make the digital euro functionally obsolete on the day it was born. The feature buried inside X's long-term European roadmap has a working internal title that Musk's payments team has been using since mid-2024. They call it the Everything Wallet, and the name is not an exaggeration. According to sources with direct knowledge of X's internal product planning, the Everything Wallet is designed to function as a single, unified financial interface that combines payments, savings, investments, insurance products, and credit, all inside the X app, all accessible without ever interacting with a traditional bank, and all operating outside the direct supervisory reach of the European Central Bank. The implications of this are staggering. The digital euro, even in its most ambitious form, is designed to function as a replacement for cash, a simple government-issued payment instrument for everyday transactions. It does not offer investment products. It does not offer credit. It does not offer insurance. It is, by design, a narrow instrument of monetary policy. The Everything Wallet, by contrast, is designed to make every financial institution in Europe, every retail bank, Every investment platform, every insurance broker, functionally redundant for the average consumer. Why would a 28-year-old in Berlin open a Deutsche Bank account when X can offer them a wallet that pays interest, a credit line approved in seconds by an AI system trained on their platform behavior, and an investment portfolio built automatically from their spending patterns, all inside an app they already use to read the news? This is the question that European banking executives are privately calling the most existential threat their industry has faced since the 2008 financial crisis. Because unlike 2008, which was a crisis that governments could respond to by injecting capital and rewriting regulations, this threat is structural. Musk is not breaking European financial rules. He is building inside them, using the EU's own single market framework as his launchpad, moving faster than any regulatory body can respond, and deploying a user base that dwarfs anything the digital euro will accumulate in its first 3 years of operation. Christine Lagarde stated publicly in March 2025 that the ECB was monitoring private digital payment platforms with, in her words, extreme vigilance. That phrase, extreme vigilance, is central bank language for panic. The ECB does not use words like that about Visa or MasterCard, platforms that have operated in Europe for decades. They used it specifically in the context of large-scale tech platform payment systems. Everyone in the room knew which platform she was talking about, and Musk characteristically responded on X within 4 hours of her statement with a single line that was retweeted 2.3 million times. Sounds like competition. The battle between Elon Musk and the European financial establishment is no longer a future scenario. It is happening right now in real time, with hundreds of billions of euros and the financial privacy of 450 million people hanging in the balance. The digital euro promises control dressed as convenience. X-Money promises freedom dressed as a payment app. And the 450 million Europeans caught between these two visions of the financial future will have to choose, whether they realize it or not, which kind of money they actually want to live with.